Right, what are we going to be doing this evening? First of all, why are we trading seasonal patterns, or why do I trade in seasonal patterns? But to begin with, just a little bit of a recap, why we're looking at seasonal patterns. And a perfect example is this chart here. It's actually State Bank of India. Not many of you probably trade it, but it's a perfect example. It's not just something that I've handpicked. I haven't spent hours trying to find the best perfect example. It's right at the top of the list right here, which we'll be talking about more about why it's significant about being at the top of this list. But if I open up this chart, this is the market that's on the notes, and this is what we're looking at. So the orange line, for those of you not familiar, the orange line is a seasonal pattern. If I just turn off current price, is a seasonal pattern. A seasonal pattern is the average of price over a period of time. So it's the history of a market. And this, in an orange, it's a 20-year. You can see at the top of the list. So everything, all the orange patterns on our platform is a 20-year, and the 20-year is the default, because all of the back testing we have done, the 20 years consistently the strongest performing of all the patterns. You will see there's various patterns we typically follow through the all year, which would be for this market be 29 years. So it's the 20-year pattern. And then there's the current election pattern, which is linked to the US presidential cycle. The current year of that cycle is the post-election, which we're coming to the end of and headed into a midterm year. Those are the three by default that we follow. There are many others, which I'll talk about as we go through this evening. But yeah, they're the main ones we have as default. So that is the average of price. And if we look at current price, so this is the daily closing price. The yellow line is the daily closing price that we've had all year. And you can see how the yellow has followed the orange. So in a short answer of why you trade seasonal patterns allows you to see how a market can move ahead of time. And this is exactly a perfect example of it. The market declining to the start of the year, makes a low in here. In March, starts to rally to the upside, then stays within a range through a period of a few months, and then we see a big break to the upside. That's what it historically does. That's what it's done this year. I'm in a much stronger position though with that information. And that's simply what seasonal patterns is all about. But to understand what's going on here, we need to know 2 points. Some of you say, you said already, have some familiarity with seasonal patterns. You will have seen a seasonal chart before, but there are periods within that aren't actually particularly seasonal. So to understand exactly what we're getting from a seasonal chart, we need to know a couple of points. First one is, what is actually a true seasonal pattern, and then how to avoid bad seasonal patterns. These are two things that the software does for us, but I want to go over them just so we understand what exactly they're doing. So what is a true seasonal pattern? And that's what this section is about. A true seasonal pattern, which I'll talk about in a second, but the difference between a true seasonal pattern and a seasonal chart, we just, actually I'm going to use pound. I'm going to use pound because pound's in that example. So let me just bring up British pound chart. So we load up this chart. I'll turn off the current year. And this is the chart that's currently on the notes. So it's a 20-year for British pound. Now, if you're familiar, have any familiarity at all with seasonal patterns, you will know that the lines suggest the seasonal bias for a market. So you see here in January, most would look at this chart and say, oh, the pound's seasonally bullish, and then it's seasonally bearish, and then seasonally bullish, and seasonally bearish, and seasonally bullish, etc., 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 etc. So essentially looking at a direction of the line and saying it's either seasonally bullish or seasonally bearish. This is not correct. And even though it's been done like this for decades, I even used seasonal charts like this for many years because I didn't have any other information. I just used a just simple average like this. But now, in recent years, obviously technology has advanced. We've created a platform that gives. We know that's not the case. What I want to illustrate here is these 2 points, or these two charts. The seasonal chart is made up of the average of price over this last 20 years. So it's a 20-year chart, and there's a difference between the average in price and an actual seasonal pattern. And I want to draw attention to this period in particular. This area here suggests there's a really strong seasonal bias to the downside, suggests pound historically sees a big decline to the downside. I'll just go back out a day. There we go. Here on the right-hand side, you'll see this, the number of times, or the percentage success rate that pound has been down during that period, and it's actually only 50% of the time. And if we go down and see at the base of the chart here, you'll see how some years it's been down, many years it's been up, and it just oscillates back and forward. That's not a seasonal pattern. Okay, that's the average of price, and unfortunately, there's been a couple of big down years in here, and actually you can see that. You can actually see that from the historical return chart at the base here. Yeah. So there's a big move in 2008, and there's a couple of reasonable move there in 2014. So that's -5%. So there's two decent down years and one big down year, which is skewing the seasonal pattern. So if we create the average movement out of all of those years, because of those three big moves to the downside, it creates that skew to the downside. But we actually don't have any seasonal consistency. It's only 50% of the time. That's not what we want. And that's the difference between the average of price and an actual seasonal pattern. And that's a key point you want to understand. If you're looking at a chart, it's for a seasonal chart, historically, you'd have just looked at the direction of the line and said, okay, that's seasonally bullish or seasonally bearish, and that's incorrect. We want to find periods within a chart where a market consistently moved in the same direction. Okay, consistently moved up or consistently moved down. So essentially what I've drawn there on the notes, the difference between this figure on the left and the figure 2 on the right, you'll see both have made up of, there's 10 years essentially of imaginary price movement, but both the yellow line is the average of both moves, okay, of the 10 years. But because of some of the figure 1 here, the big moves to the upside, it create a bullish period, and the same with figure 2. But in figure 1, there's only been 5 up years and 5 down years. That's not a seasonal pattern. A seasonal pattern must be recurring. It must repeat consistently and have that repeating quality to it. But it still shows it's been up that yellow line because some of the years had big movements, so it skewed it to the upside. We get the flip reverse of that here in pound, where we get this big move to the downside, but actually it's been dragged down to by those 3 years. A true seasonal pattern is where a market consistently, say, moves in one direction. The software is programmed to only look for periods that have at least 70% of the time either moved up or moved down. Okay, so the last 20 years is going to be 15 of the last 20. That's what we're going to be looking at, the kind of statistics we're going to be looking at. That is a seasonal pattern. That is what these periods are, if I just take them up, at the bottom of the chart. Each of these are optimum seasonal periods, and you can see there is no, because you would look at that and think, well, that looks like a really bearish period. There is no optimum period there because there's no consistency within it. The periods we have at the bottom, these are the periods where the market has consistently moved in the same directions. There's pound 80% of the time down through this period when pound's been in a significant move to the downside or downtrend. 80% of the time in the last 20 years through that period it's been down. So when you're looking at a seasonal chart, don't just look at isolation, just follow the line and say we're seasonally bullish because the line's going up and seasonally bearish because the line's going down. That's just the average, or a lot of that movement will just be the average movement of price, which is not the same of a seasonal pattern. A seasonal pattern is something that recurs, it repeats, and the market consistently moves in that direction. So for years, I suspected that was the case when I looked at just a plain, simple seasonal chart like this. I looked at a 20-year seasonal chart for years, and I've traded with seasonal patterns. And I long suspected there was areas within it that were just made up of noise, but without getting into a lot more detail and actually having a tool like this to go and find those, it was hard. I used Excel for years, and I wasn't that skillful in Excel to try and find those periods, but now the software does. So you look at a seasonal chart, make sure you're able to identify where the actual true seasonal patterns, and that's what this the software does. You can also go and find your own on here with the range finder, but that's what we're going to be looking at. So the two key points to understand what a true seasonal pattern is. The first one is being able to identify a genuine repeatable pattern. And I say that's what the software does. Those the bearish ones are the orange, the bullish ones are the blue. The start dates of these patterns is what's contained, is what's shown here on the seasonal planner, okay, which I'll come to a bit later on. The second point we need to know, just before I move on, actually, I did write a blog post about this. It's a while ago, but with these examples, just so you want a bit more detail, there's a link in there to go through to that blog and read a bit more detail on that, just as it explains that. The second point is how to avoid bad seasonal patterns. It's not a case of the seasonal pattern being bad, it's the application of the seasonal pattern being bad. Again, traders, any kind of understanding of seasonal patterns, and even I've seen I see experts posting seasonal patterns online, forums, example, all the time, and they talk about a market being seasonally bullish or seasonally bearish. But the one big mistake I see repeatedly is the fact that market's just not following a seasonal pattern in the first place. If a market isn't following a particular pattern or a set pattern like a seasonal pattern, then the likelihood of it following at the point you just happen to look at it just because the line goes up or down is extremely unlikely. So that's a big error that I see with a lot of people that just think, okay, we'll just use this point here, for example. Okay, now pound's seasonally bullish in July, but it's been doing whatever it wants the rest of the year. It hasn't followed any of the pattern. We haven't went up here. We haven't come down here. We haven't followed any of the pattern prior to this period. But they look at the line and go, well, the line's going up, so it's seasonally bullish, the pound must go up. That's not the seasonal pattern's fault. That's the application of it. If a market isn't following a pattern, isn't following a predictable path, and I would say this one, the top of the list, is the most seasonally correlated. This is a seasonal market. This is a market that's following a seasonal pattern. It's following a pattern that we are familiar with. We know we can track. That is a market we can there. Whenever it comes into an optimum seasonal period or a seasonal period in general, we can then anticipate with a much higher degree of likelihood. It doesn't guarantee it at all. Not that we have no guarantees in this market. But it gives us much more certainty that if we're heading into a seasonal period, whether it be bullish or bearish, the fact that it is already following a pattern suggests there's a much greater likelihood of it continuing. So that's a really, really important point whenever you're looking at seasonal charts. And that's something we do. I've never seen it talked about anywhere else, to be honest. I've done it for years. Done it for years visually. I would have always taught traders just to look visually on the chart, price with the pattern. Are we moving up at the same time, moving down at the same time? Are the highs and lows around the same timing? So always done that visually to confirm we're following a pattern. The software now does it via measuring correlations. So it's mathematical. We look at the correlation between the seasonal patterns we follow. We can also do it for any custom pattern that we make and current price. Okay, and if there's a positive correlation, then it tells us confirming we are following that pattern, and there's a greater likelihood if we're likely to continue in that way. If a market is not following a seasonal pattern, then I'm not just going to expect it to just go up for this because the line's going up. I'll just bring it up. From the notes here, these at the top of the chart, this is actually taken from the seasonal chart. These are the correlations. It's a 20-year chart we're looking at. This is the 20-year, and it shows the correlation. It's a 96% positive correlation, which is a ridiculous correlation for when you're measuring anything. The 96% suggests we are literally 1 for 1. And you can see how closely it's tracked, and it's done it all year. A market doesn't have to do it all year. We certainly wanted to do it in periods, maybe 3, 4, 6 months, but it's basically been the entire year, and there's quite a lot of markets do that. We'll see gold in a second. Has also done that. So that's what we're looking for, and that's what these correlations are at the top of the chart. And it's also what the color-coded, this section here, the color-coded areas around the patterns that we have in the planner, which again, I'll come back to the patterns when we get into the rest of the presentation. But essentially anything with a green around is a strongly positive correlation. There's lots of red. And that suggests the market is not following a seasonal pattern. If it's not following it, it doesn't mean it's impossible not to follow it, but it certainly means it's a lot less likely, a lot less likely. We've done, again, a lot of back testing on it, the difference in the performance between correlated and non-correlated, and there's a huge difference in terms of the outcomes of it. So that's why they're there. The green is a positive correlation of 50% and above. Orange is positive correlation, any positive correlation, but a weak positive correlation. And red is a negative. And if we look at something, just pick a random one here. Actually, it's a slightly negative correlation, but more so because we started just at the end to dip off. It's not the worst pattern. Let me see what Garmin is doing. There is a very good example of a negative correlation. It was perfect for a lot of the year. Very, very nice. We see the optimum period we have in here. Really nice, strong correlation there. Nice correlation there. Strong period. I suspect there's been earnings in here. We've seen a big decline. And as we're coming into an optimum seasonal period now, there's clearly a big divergence between price and the pattern. I have no interest in trying to trade that seasonal pattern just because just because the chart suggests it's seasonally bullish, that's incorrect. That's not the fault of the seasonal pattern. That's the fault of the trader trying to apply it to it. So if a market isn't following a seasonal pattern, and we can see it here at the top of the list, is clearly not. 20 years -1, the all years -73. So big divergence from that. I'm not going to simply just assume that it's going to follow that pattern. So anything red, I recommend you to stay away from. Brett, I assume I answered that. So the blue's positive, so bullish patterns, and the orange ones are bearish patterns. So period would expect the market to go up or down. But any questions we go along, by all means jump in. But let's try and put the software to use in terms of the outlook, what we're actually going to be looking for. Looking at the US equities, and take a quick look at some of the other indices as well. But the US equities, it's a big move this afternoon. I was in trades at the open, but closed because we're at resistance, but I was never expecting the decline that we've just had. But yeah, interesting day. So yeah, outlook from here. So we'll look at the seasonal patterns. We'll look at what the software can do, how we can actually move through and build up a picture of analysis from it. So we're looking at the S&P 500. Currently, we're in a daily downtrend, very much so in a daily downtrend, but it's still entering one of its historical bullish period. On November 21st, there's typically a big swing, usually to the upside. It's only the 21st yet, so or 20th even, sorry. So let's see what tomorrow brings. But around the November 21st, there's a lot of markets that typically turn bullish. A lot of equities turn to the upside. So we're in a period where we typically do see some change. And we can see this is the 20-year pattern. The orange line is a 20-year pattern for the S&P 500. The period from the 21st of November through to the 9th of December, it has a 75% success rate over the last 20 years. And you can see actually it does suggest a low. I will bring up the chart in a second, but just talking through what we have here. It does suggest a low here on the 21st, which would be interesting to see if it actually does that tomorrow, and then see that move to the upside. I can bring that up in here. So the S&P 500, we have 74 years of price. This pattern is looking at the last 20 years, and say you can see here it doesn't include the yellow line is the current daily closing price. It obviously doesn't contain the current move. That'll be updated in the morning. But you can see how it coincides with the low. You can see the low here on the 21st. And if I click on the pattern at the bottom, you can see there the 75% success rate, and in that move through from to the 9th of December. Typically runs higher. The optimum patterns looks for the highest return over the shortest period of time. So it doesn't mean the market declines on the 9th. You can see a bit of a pause here, but typically equities continue strong in between Christmas and New Year's, actually, interestingly. But yeah, that's the sort of the optimum period with sort of the highest return over the shortest period of time. Suggests that run through into the 10th of or 9th of December. So that's what we're looking at, and that's the bias. And I say for years, for me, looking at a seasonal average, that's all I simply would have done. I would have looked at a 20-year average, simple average like this, not even knowing the 75% success rate, just seeing that there's a low here, and a market typically move to the upside as bias. But now I can actually see the details underneath the surface. There's 75% of the time. So that's 15 of the last 20 years. But we don't have to just take the word of that. We don't have to just look at the seasonal average, say one average says we're seasonally bullish. We can go a lot deeper, a lot more information than what we have done prior to that. So there's a couple of ways I've done, and I broke this up just so you can actually see what can be done, what analysis we can do. So I want to just click on this, and you'll see in the notes this graph here. This is the patterns return, or the annual pattern return graph at the bottom of this. So any pattern you select from the seasonal chart, you can scroll down. Now this shows the return of that period for every year over the last 20 years. So actually a big move in 2008. 11 is pretty good, but you can see fairly consistent through the 20 years. Any years that were down were actually limited on the downside. There was 2 years down there. They were barely just down. There's only really 2015 and 2022 where I actually seen anything meaningful, even fairly limited in terms of meaningful, but certainly was down. So you get to see the consistency of the pattern. I like to look at this graph. I like to see what's under the surface. I like to look for the consistency of it. I don't like to see big erratic moves like this, where some years was just barely in and we're dragged up by maybe 2 or 3 years. Don't like that. I like to see consistency in a pattern, not just the fact that we've been successful. There's nice consistency there, and there hasn't been big drawdowns. Okay, so what we can do from there, and what I've done on the notes, is that we can actually look at the down years. So there's been 4, or actually 5 years, so 15 years where it's followed that pattern. And there's been 5 years where the market has declined. These periods here, the orange, where we've declined. So it's a bullish pattern. Anything negative in here means that pattern failed in those years. But we can actually look at those years to see if current price is following that pattern, and to suggest maybe is actually this year is going to be one of the broken years. Okay. The fact that the 20-year is actually a pretty decent 21% correlation, but just sort of breaking down here, you'd see it's been a pretty strong relationship with the pattern overall this year. But there is a possibility maybe it's breaking down. So we can start to dig deeper, try to paint a picture. What is the likelihood that we're looking at a year that actually doesn't fit the norm? And we'll see. I've got on the notes in here. Sorry, I've got the notes in here. I do the notes in here. Yeah. 2005, 15, 18, 21, and 22. So we can do that. We can go in here and select, and you turn that off. We can go in here and select the year. So 5, 15, 18, 18, 21, 22, 18, 21, 22. So you can make any seasonal pattern that you want in here. I'm not recommending you do just go and make up a seasonal pattern. But if there is something that you are aware of in any market that has happened in certain years, maybe some obscure things, then you can build up a pattern of what that market typically does around that event. So you have the flexibility to do that. And if we do that, if we take we isolate those 5 years where the market hasn't been bullish through this period, mid-November through to mid-December, we look at that, we get this seasonal average. And yes, that seasonal pattern suggests a decline to the downside, but it's a negative correlation. To me, this market, current price, isn't following that pattern. So the fact it's not following that pattern, to me, the likelihood of it now seeing a big decline to the downside, today's current price action notwithstanding, but looking at it in this context, I wouldn't be expecting the market to follow this pattern and see this big decline to the downside in December. I wouldn't be expecting that. So then we go back to the other years where that price, where we have had the other 17 years, and they create this movement to the upside, obviously where we have the average. So again, we're starting to see a picture. It's unlikely we see much movement to the downside through this period. So we've looked at the years where the market has broken down the current pattern. These are orange years, the 5 that we have on here. And the market certainly isn't following. There's no correlation with that. So not to suggest that pattern is going to play out. We can dig a little bit deeper. That's that pattern we just looked at. And we can then go and start to make up custom patterns, start to look at hidden patterns potentially. So we're in the month of November. We're in a current downtrend, yes. And we can go and isolate years that have had bearish Novembers. And this in the S&P, it will look at all of the data. It'll look at the 74 years of history, whereas the current pattern's just looking at the last 20 years. So it's looking at the last 74 years of history. There's a few years in there that have bearish Novembers. And again, is there a correlation between current price and that pattern? Well, the software shows a minus 44% correlation. There was certainly a bit of a correlation in here, but that's maybe coincidence more than anything. But no, there's been a decline. Typically that big acceleration to the downside in November, there's generally a decline preceding it. And interestingly, even with the periods where we do have a bearish decline in November, typically still makes a low. Here, the average still makes a low here on the 21st. 21st of November, we make a low, and we still see that move to the upside. So we've looked at the history of the S&P in various different ways. This is something I'm a big fan of, looking at the price movement in certain months. There's a couple of really good examples we're going to be looking at in the dollar, which I'll get to. So you can actually see how prices have moved in certain periods, which is against the normal typical pattern. And this is one way I would do it. November negative, and the final one. So we've ways of digging in deeper. The last one we can look at sort of a custom. It's True Path, which is basically asking the software to go and find all the years that match current price, that are closely aligned with current price. And again, it suggests we continue to push higher through to the end of the year. So looking at whatever way we can, looking at seasonal patterns. Again, it doesn't mean the market can't decline. It does not mean that at all. We're looking at seasonal patterns. It's about, well, for me and for the vast majority of people that I know that use seasonal charts, it's about preparing for the most likely outcome. What is this market likely to do? Are we likely to move higher or likely to move lower? How should I be preparing? And that's what seasonal patterns are for. There's lots of traders out there that do not trade with a bias. Simply going to a chart, looking for momentum, spotting the direction on the day. That's you. That's fine. I have no problem with that. I don't know many traders that do that. I'm not saying they're not out there, but I don't know many traders personally that do that. I, for one, very much more comfortable having an understanding of where a market's trying to go, what is the likelihood of it moving either higher or lower, and then planning accordingly. And then, for example, the likes of the S&P and equities in general, if my bias is for the market to move to the upside, I'm planning for the upside. If it doesn't move to the upside, then I'm not involved. It has to follow with what I'm doing. That moves into the next section. Oh, sorry, that's a dollar index. Next section is what now? It's not a case of, yes, there's a seasonal pattern on the 21st. Do we just buy tomorrow? If we get to 6,500, it's possibly that I do just buy tomorrow, but we'll see. We'll see about that. But generally, the plan is no, we don't just simply buy just because it's the start date of a pattern. It's about looking for the price to fit, price to confirm what you're thinking. For the vast majority of you, this daily downtrend won't fit. I would imagine a lot of you online, I imagine, be watching trend traders buying a market in a downtrend is probably not something you're going to be looking for. Possibly making a low here, starting to see a change of trend on a smaller time frame, maybe, and then trading once it's confirmed we've got a change. Maybe you want to see the market change trend completely, so we're up here. Whatever it is you're comfortable with in terms of actual trading, that is where you enter. It's nothing to do with the date in terms of the seasonal pattern. If it's suggested 21st, if I get an opportunity to buy on the 18th, then I buy on the 18th. If I have to wait until the 28th, I wait until the 28th. It comes down to where I want to trade and how I want to trade. On the notes earlier, I started writing these much earlier. The market was still pushing up quite nicely. I'd said for the most part, I would probably be looking for a breakout above that sort of 67.50, 67.60 area. That's what clearing out of this area, getting above the moving averages again in the daily, that would start to free up some space to the upside. Again, if you're in the boat where you want to clear and actually break out above here, I have no problem with that. But the key thing is the seasonal patterns aren't just there to tell, they're not there at all to tell you just to buy and sell on certain dates. It's giving you an idea of where a market's heading into, either that bullish optimum period or a bearish optimum period. The market needs to turn and confirm. The price action needs to align with that. Currently, certainly looking at the S&P, a lot of the equities, they do not. I don't mind the level, as I say, just below on the S&P. I don't mind the level either, sitting just below on the NASDAQ. Today's price action, not massively concerned by. It's the same as this. I wasn't concerned by that either. That looked like exhaustion, and I was very much happy to be a buyer very soon afterwards. But we'll see where we're at tomorrow. I do like to trade on smaller time frames around on the indices. There's a possibility I could be a buyer tomorrow, but we shall see. For the most part, I would recommend waiting for confirmation, waiting for the trend to change, maybe to build a base down here. We start to break to the upside, and then get a confirmation from that reversal that yes, it's now a period to be buying. The seasonal pattern is just the window of an opportunity. Price needs to align with that window, and if not, move on. Simple as that. So yeah, my bias, regardless of what current price is, my bias is still higher. It's a question of when I get that opportunity, or if I get the opportunity to be a buyer. A key point we're going to be going through later, there's quite a few other examples or other patterns setting up for a move to the upside. Equities in general, as I say, typically around sort of 21st, 22nd November, we start to see those moves into year end. If the indices haven't turned, then I'm not going to be looking at lots of stocks to, obviously, I wouldn't be expecting them to have turned anyway, but I've been looking for the market to turn together. So if the indices haven't, then it's going to postpone any of the others, but we'll look at those patterns as we go along. So yeah, hopefully that shows how you're able to go in, dig into deeper. You don't have to just look at that one seasonal pattern and just go, well, it's seasonally bullish. Try to take it apart, try to break it, try to see where it's wrong, try to see how it's maybe misleading. You can do it in many different ways, but if you, as we've seen here, if you try to break it and try to look at under the surface, it still points to the same thing. The bias is still to the upside. Doesn't mean it has to go up. Maybe it's going to be one of those years where you just see a big decline to the downside. If that's the case, then I'm not buying. But until such times, but below the level here, 6,500 for the S&P for me, and the Nasdaq, those two levels, below those levels, then yes, I'll start to obviously question, and I'm not going to be looking to be a buyer. But whilst we remain above those price actions, certainly it's not how you would ideally like it to be. But we've seen many times with equities do that before, and they return back to the upside. So I don't think it's the end of the world just yet. Just on a separate note, next year is a midterm year. Midterms are typically the most underperforming years when it comes to equities. So if we are going to see underperformance and a significant decline, midterm years would be ideal for that, or perfect timing for that. So yes, there is a possibility next year, but I still think we have a decent end to this year. Moving on to the dollar index. All you currency traders there. Yes, what is the bias? What is the plan? Bias for the dollar. Historically, if we look at seasonal bias, the dollar index, we typically see a move pretty much the lows from here, mid-September, and we rally through to around here, mid to latter part. Actually, that's a high 24th of November, but actually I guess over the weekend. So yeah, and again, not about pinpointing an actual day, but it suggests we're not far from a high in here. Looking at this pattern though, obviously have a problem with it. We do have an alignment here. So from this period here, middle of September forward, we look quite fine. We have seen the movement, the retracements, the cycles pretty much in line with what we typically get. But the rest of the year, I'm less keen on, okay? And this is what I talked about earlier on. The market must be following the pattern for us to use the pattern in a confident manner. So yes, I'm happy that the dollar is following the pattern. It has been following the pattern from here. And if we continue to follow the pattern, it suggests we make a high not far away from we currently are. And the general bias then for the year end is for that move to the downside. But the fact that we're not following it, then I want to ask some questions. What is, maybe we're going to continue to not follow it, and therefore say maybe be bullish, we just do this. So again, we can dig into different ways. We can look at various areas. True path is one we can do. So again, just asking the software, this true path, just to calculate, show me the years that match current price. So more the recent current price. It shows the current alignment that we have in here. Again, this period. So it's not looking the entire year, it's looking at more recent price. And it also suggests a peak in here, pretty much the same time, 21st, 24th for the same peak. The problem I have with that is, again, like the 20-year, it doesn't really fit. Again, it seems to be more like sort of curve fitting, trying to get something to say what you want it to say, which is not what we should be doing. So yes, it fits here, but it doesn't fit the rest of the year. The one thing I would say and brings positive is both of these suggest when we are performing as we are through this last few months that we do see a peak in November at exactly the same time. But still, I think we can do it better. And this is what I talked about earlier, this section. The ability to look at a market in different ways. So if we look at historically, as I put in the notes, there's a number of years in here where the dollar index has moved differently to what it's currently doing, or what it historically has done. You'll see here, so February is one. Historically, we typically see a strong performance from the dollar, but we were actually negative here. Fast forward, then the summer was definitely a breakdown. We've seen big move to the downside through June, when historically it's typically strong. We then see the big move to the upside, or a decent move to the upside when it's historically down. And then in August as well, those are diversions. And the rest of the year, it was actually pretty close. Just mess here, we generally is a mess. Decline here, to rally here. So out of the nearly 11 months we've had, there's only really been 4 we've had that breakdown. But we can start to look at what is the picture. So let's look at years that were bearish in February. So show me only years for the dollar index whenever it has been down in February, seeing this bearish move to the downside that we've had this year. Then I'm starting to see a pattern that actually looks quite nice, certainly through the early part of the year. So there is clearly some consistency. So whenever we do see that bearish February, there is a consistent path for the market to move to the downside. Starts to break a little bit here, but generally it's for the range bound nature, a little bit of an increase through this period. And again, it also shows a decline. It shows a peak in here in 24th of November and another decline. And there's a reasonable number of years in there as well. So it's not just clicking that'll bring one up. So we've got 13 years in there. 13 years out of the 38 history we have for the dollar. And again, that points to a high and a move down. So we're looking at, just like we did for the S&P earlier on, trying to sort of look deeper, trying to find if there's any similarities in the price and in the patterns. And 3 patterns we looked at so far all show the same thing. They all show a peak for the 24th, pretty much where we currently are approaching, and that decline in through December. Another year or another month, we could look at this June. This June to the downside is not one of the ones that we were looking at. Let me see, we just isolate that. So yeah, historically we're positive through June. June, actually we're negative down through this period. Do the same again. What does that give us? A negative June. So years where June was bearish. And look at that pattern. Not as close as the other, but again, it does still show that reasonable alignment, this move to the upside, and again, a peak and another decline. So again, it's building up a picture. I'm starting to see similarities, even though none of the patterns are really strong and perfectly correlated to the likes of what we had here. There is a correlation and there is a bias for the market to move to the downside. So therefore, planning for that seems to make sense. My bias would be for a move to the downside. Anticipate that. Look at the chart, and I have this in the notes. I like the level that we're sitting at. We look at the weekly chart. You could argue certainly we're building a bit of a base in here, which could extend to a decent break to the upside, but doesn't mean we have to do it here. We could stay below this area, and then we get in the new year. That would fit quite nicely into January for see that move to the upside. So it doesn't mean just because we are building a base, doesn't mean we have to break out of that base straight away. But there is a nice level there, a nice 50 moving average on the weekly chart. You can see in the daily chart we've had nice price action moving into that level. Currently sitting with a rejection, and I do actually like where a number of the other charts are sitting. So if you were bullish, there was a few of you who are bullish in there. If you are bullish, I'd be looking for a move above that level. But even with that, I think we could possibly get a little bit higher. Going back a few months ago, I thought we could get up around 101 before we'd actually make that peak and then see that move market decline. So I'm keen to see how the rejection is here. How do we react from this level and move to the downside? I wouldn't be surprised if we see a spike above a field breakout and see it move back to the downside, something like that. That's something that would be quite common and quite easy to see from the dollar index, but my bias is to the downside. Again, it's planning for that. I'm not just going to sell here, or I won't. That's not typically what I would generally do, or not very often, depending on the level occasionally, but the pattern wouldn't be strong enough for me. But it comes down to what you want to see. Is it a case of a smaller time frame trend change? Do you want to see the daily breakdown? Do you want to see it break below the lows? Again, it's not about the start date of any pattern. It's about whenever the chart agrees with your bias. And for most, yes, you might be looking at it and say it's a potential double top, but it's only a potential yet. It needs to go through here before it's actually confirmed as a double top. It could sit below this area and then see that break to the upside. So it's all about the bias and the planning. It would certainly put me off being a buyer in here. If we do get a break above that level, then there is a very real chance we have a field breakout, and I don't want to be caught in that. And with my bias being on the short side, then I'm not going to be inclined to want to chase those longs in that direction. So yeah, that's my view with the dollar. I think the likely path is for that move to the downside. It would fit nicely if we do see the equities bounce in the coming days, equities starting to move to the upside, and then seeing the dollar to move to the downside. And those two would fit quite nicely. And lastly, in terms of outlook, before we get actually into the others I have on my watch list, gold. I know everybody's been talking about gold again. It's become the new Bitcoin. It's back sort of top pedestal again, number one market. Everybody's enjoying trading. What is the outlook? I said earlier, we like to trade boring markets. I showed the example of that State Bank of India. If we look at gold, if we just type in, gold is another very good example. If we look at, again, sorry, just so I'm not confusing you, so I'm not just picking random lines, so ones that I want to follow. At the top of the chart, I talked about with the seasonal correlations. So far, I've looked predominantly at a lot of the 20-year averages. But if we look at the 20-year core, so this is, we've got 50 years history on gold. The 20-year correlation with current price is sitting at positive 27%. It's a positive correlation, but it's a weak a positive correlation. So I'll be less inclined to want to follow that. It doesn't actually look that bad, but it's certainly, again, more in here. It looks a little bit more like a kind of the same as opposed to just actually being the same. Whereas we can see the other patterns are actually stronger post-election and the all years. And if it's a toss-up between the all years and the post-election or any of the election cycles, because they contain a lot less years, I'm going to be going with the all years. So if I put that on, that's going to be the one I'm going to be interested in. And then you start to see what actually historically gold has done. So we get 50 years of history here, and gold has followed the entire year from start to finish. We've had the big move up start of the year, the big range then through the summer, and then into Q4, that big move to the upside. Then we correct. Typically in here, it's around sort of the 12th, 10th to 12th of October. Went a little bit higher. The momentum drove it a little bit higher, but we typically do see that peak in October. And interestingly, even the nature of the correction, we see that move to the downside, the initial correction, a little bit of move up, then the correction continues. We've done that. Then we make that low, and then we start to build for that move to the upside again. And that's what gold appears to be doing in here. So we're even following all the little deviations in the pattern, which I'd never expect a market to do, but it's nice when it does. The historical pattern suggests actually we make a new low in here. Current price action is actually suggesting we're going to make a higher low. Maybe see that move to the upside, which is even more positive. So it's outperforming the seasonal pattern, which is great. So there's not really much digging to be done in here. There's not really much digging. You need to go into the seasonal bias. We're following the pattern. We've followed the pattern for all year. So there's not as much digging I want to do. It's simply a case of, we can bring up the chart here from the top of the pattern. It's simply a case here, we're building this low. I wasn't a huge fan of the price action, how swiftly it come back into this area, but we're currently building a base in this zone. If we can stay, and I think on my charts we should have, no, it's not there. Yeah, we've got this little box. If I drop into the 4-hour chart, again, so it's a case of where do we trade it? That comes down to personal preference. The seasonal charts give us the bias, how to anticipate and expect a market to either move up or down. We still have to find a place in the chart that actually fits. So there's a possibility we have made a seasonal low in here. I like the fact that price action's got weaker through here. We're starting to see nice momentum to the upside. Again, sellers are really struggling here. We keep seeing buyers coming in all the way through this as we appear to be setting up a nice higher low on the 4-hour. For me, given the current structure, I would be looking for a move above the 4-hour high. There's a nice level through there. If we get back above that point, that would be of interest to me. There is a possibility we're not done in here. We come down. Maybe we do actually correct like the historical seasonal pattern does. My preference would be if we stay above the 4,000. 4,000 is a nice level. That's where the recent low has stayed or stopped. My preference would be that it doesn't break below that point. Wouldn't completely rule it out. I think as long as gold stays above sort of 3,900, as long as it stays above that area, then it can still build that base for that move to the upside. But my preference would certainly be in here. Staying here, building from here, starting to see that break to the upside above that sort of 30 or sort of 40, 41, 30. Then it would be of interest to me. Silver's almost identical, happy with that. Again, I wasn't initially particularly pleased on that. The price action, how swiftly it was coming back. Price action looking there, I'm sure a lot of you are thinking, oh, they look like double tops, particularly silver. Again, it's only a potential. If we could be a cup and handle, we actually break that high and continue higher. So the pattern is whatever you want it to be, essentially, whenever you're looking at patterns like that. And it's very easy to mislabel things, or certainly label them ahead of time and give yourself a bias. Then it's only a double top if we get certainly below this area and actually take out these lows and see a breakdown. I think there's a lot of price action or a lot of movement before that's going to happen. There is question marks. I didn't like how we come back here. 50 is a key level on silver. We stay above 50. It's of interest. Again, it's trying to make this higher low on the 4-hour. We can build this base and see that move and break above that high, that would be of interest again. It doesn't have to go right here, right now. Say the pattern still suggests we build in this area, and then we get another opportunity to see that move into year end. But it's done what it needs to do all year. It's followed the same pattern, and these are the kind of markets I like. I like boring, predictable markets. It's fantastic. But gold has been a boring, predictable market. But yeah, that's what I like to do. I like to trade a market that's following a predictable pattern, not trying to overcomplicate things. And as long as it continues to follow that pattern, I will continue to anticipate that movement via that pattern. Looking ahead to some of the patterns moving forward, as I mentioned, I'm going to quickly go through it. I don't want to keep these all night. Bit of a run through. There's a couple of the currencies, as I mentioned, seasonally. Actually, we'll go down to the table. The heat map very quickly shows us the performance of each market given any given month. If we look down here, we can see the euro. EC is the euro. Currencies are at the top of this. That's the futures codes, and they're all divided by asset class, but the currencies are at the top of this table. And you can see, Swiss franc as well, but the euro is a really strong performer through December. I could actually bring that up. Look at the euro. And it, like the dollar is suggesting, we're near a peak. The euro suggesting we're also near a low. We didn't have the big decline that we typically have, but we have had the decline from September. We have been in this downtrend, but it's still sitting at a nice level of support. So an area, if we're able to bounce from here, euro would be something of interest to me. I like we can see the deeper phase 1 and this really weak, deeper phase 2 within this daily downtrend. So the deep phase 2, the really weak phase 1, possibly setting up for a drive and that move to the upside. So it's something I'll be looking for here, a change of trend. So I do quite like euro, but also, and I put on the notes a pattern that I like. So I like where the chart sits. It's Kiwi. We haven't had a really strong correlation through the year, but we have had certainly periods, essentially really from here with a big move to the upside through April. We peaked a little bit early, but we've seen that lower high, and we have had this downtrend through that bearish period. We're now approaching this period. We typically see that move to the upside. It's quite a short period, but historically, 75% of the time we see that move to the upside. I do quite like Kiwi, but it'll be a case of looking for dollar weakness confirmed, and then looking for the leader. So I'm not just going to be buying Kiwi just because I like the pattern. If the chart doesn't confirm, it's of no interest. But I like the area it currently sits. This probably won't suit a lot of traders. We're very much in a downtrend. A lot of you probably won't be involved until maybe we get it back above this area. So we make a low through here. We start to see a break to the upside. In that area, certainly would make sense. But again, it gives me the bias and the anticipation that this downtrend is less likely to continue. We're possibly near the end of it. We could get a little bit lower, but there's certainly a lot more areas of support. So I'm not going to be inclined to want to chase lows down in here, and then possibly looking for signs of exhaustion. And maybe you look at these price action through here, suggesting actually sellers having that last push to the downside, buyers starting to come in from profit takers coming in, and we could be looking for that move to the upside. So I'm not looking to be a seller, because the bias is for me to anticipate and expect a trend change, but I'm not a buyer in here either, because obviously we're in a clear downtrend, so I'll need to see a change in sentiment, change of direction. And a simple way for a lot of you, I imagine, would be looking for a break back above that area. Back above that level would make sense above essentially 57. And I'll fly through a couple of the others. I'm not going to go through all of the patterns, because actually I could be here for quite a while. But yeah, a couple of examples that I like. Apple's on the list. I do like where Apple is currently sitting. We're heading into another bullish seasonal period. 75% success rate with a strong correlation. If we look at the performance, it's the 7th optimum period through the year. I think all of them have been successful, apart from possibly this one where the market just went sideways during that period. But the rest have all done what they should do, even the decline through this period. So we're heading into the 7th and final, we've done 7 already, into the 8th of the year, looking for that last move to the upside. Looking at the chart, again, I did actually have a trade in here, but not anymore, but I've been looking for a break to the upside, ideally from this area, so above 277. I would be interested in further longs. I don't mind. You can see the little dips out of these structures we've had previously as well, little dips. I would like Apple to stay above that level. So stay in this range. I don't mind where we currently are sitting. As long as we could break above that area would be of interest to me. The next one I really like is CAT. Really strong performer. We can see a nice correlation with a lot of patterns actually. And you can see this little corrective phase through here suggesting we're seeing this move to the upside. And it's in a nice kind of pattern I like to trade. Getting squeezed in here. Volume holding steady. I'd like to see it turning up in volume, but we're not unlikely to be with current price. If I can see a break above 570, I would be interested essentially taking out today's high. So as long as it stays in here, I'm not of interest. If it breaks below that level, I have no interest, but I like what it's doing. I like the pattern. And we're just looking for that last year-end push. It's done very well in terms of how it's performed already this year in line with the patterns. But the key thing I'm trying to show here is it's not a case of just going, okay, it's seasonally bullish, we're heading into a pattern. The pattern is there, and it's got a 75% success rate. I'm not just buying. Looking at the chart, we're stuck in a correlation. Or stuck in a consolidation. I need to see that breakout. So again, it's about timing. If we break down, then I'm not going to buy it at all. If we stay in here, then we have to wait. At such point, a point in time, I do see a break to the upside, then I'm going to be involved. Okay, so the chart needs to agree. At this point in time, it does not. One thing I actually want to bring up as well, and I'll not go through all of the patterns, but this is one, FedEx. Looks really, really nice in here. The correlation, the move, and it's just a point I want to make in terms of how you trade a pattern. There was definitely a divergence earlier in the year, but we've seen a nice correlation through the rest of the year, and now we're seeing that break to the upside when we typically would see a break to the upside. We've got two patterns here back to back. One's already completed from the breakout. We're heading into the second one. So you would see this on the pattern or on the planner. November 17th, you would see FedEx, November 17th. And there it is, FDX. And that is the pattern that we've currently brought up. And so if you click on that, it'll bring up that pattern. It is green, we've got a positive correlation. I won't trade this pattern. And the reason simply being is it's just not what I trade. Nothing wrong with the pattern. It has a high success rate. I typically, when I'm looking at equities, and a lot of markets generally, but looking at equities, I'm looking for squeeze. You can see like the cat getting squeezed in tight areas. This isn't even ideal like that, but there's clearly a range here. I'm looking for areas where I can get a breakout or out of a break from this area. I don't generally trade retracements and continuations like that. If you do, that's fine. I generally don't. So the point I'm trying to make here is not just a case of looking at a seasonal pattern or any seasonal pattern and going, okay, this market must go up, and then trading everything that moves. I like to trade in a certain way. So I will trade patterns that are in line with how I like to trade. That's a key thing. If you try to trade every pattern, you're going to trade with trend, counter trend, phase ones, phase twos, range breaks, ranges, all sorts. And I don't recommend you do that at all. Do not recommend you do that. I recommend you hopefully you already know what your trading style is, and you trade patterns that are in line with your style. If you've managed, this has got two patterns back to back. If you've managed to get into the first one and still in, that's fine. And just manage the position and stay. But I'm unlikely to trade up here on a retracement, on a pullback within a trend. It's just not how I typically trade them. But it's a point that I wanted to make sure the pattern fits with how you trade, because there's too many things that can go wrong with various different styles of trading. See, if you keep doing the same thing in the same style of trading and then follow the patterns that are in line with that, it's much more consistency and much likely to go how you expect. Lots on here, and there's honestly, I didn't realize even I'd got us so far in a number of pages that I've had, but there's lots. Just to give you an example here, if you click on the little dots at the bottom, you can see the number of options. When we get into the end of November, there is typically a change. Okay, there is a lot. I said earlier on to focus on green, so that green is the correlated markets. We can reduce that list by looking at only optimal. That shows us only the green ones. And I would recommend, if you are new to seasonal trading, that you just focus in on the greens. That makes the list a little bit more manageable. But if you've got more time and you're a little bit more experienced, I don't mind you digging into some of the others. No problem digging into some of the others, but certainly starting off, and certainly it helps to make the list a little bit more manageable. You can filter down optimal. Obviously, you can filter by different asset classes as well. By default, it just shows absolutely everything. But there's loads I could have put on here. Some of the UK stocks, Rolls-Royce is setting up for a nice one. I'm not a huge fan of where the chart currently sits. I'm not actually sure where I would find an entry at this point in time. It'll probably have to break back above the recent lows in here. I'll not bring up the chart because I don't want it to be running on too long. But it is certainly in an area we expect to see a low, so it's on my list. ING as well has actually broke out of a range and actually retested into that range. That's a bit of interest. There actually is the range we have. We've just broken out, come back into retest, building a bit of a base above that level, possibly moving away. So that's on the list. There are dozens more I could have put on. This could have been a 50-page report. Spend some time going through the lists. It'll not take long finding options. If anybody is new, I know a lot of you are already subscribers. If you aren't, if you want to do some digging yourself, everything I've went through to this evening is included within Pro Seasonal Trader. And then going forward, to say you always have the option, the pleasure of listening to my voice every Monday night. Generally, I'd say I did miss Monday past, but generally every Monday night, and I go through various patterns, currencies, equities, commodities, and spend a bit more time on the technical side of things as well. Until then, let's see where this finishes, whether we get a rejection off this level of 6,500. Does the dollar index reject that? Oh, so that's the euro. Does the dollar index reject this level? We're definitely in really interesting points in a lot of markets. So have a plan ahead, wait for the market to agree, and then take action. Okay, guys, see you on Monday.